Welcome back. Now we talk about financial analysts. Don't we love them? So financial analysts are, of course, a very important building block when it comes to the information environment of equity markets. And there's a super rich and mature literature on financial analysts. And full disclosure here, I'm not an expert. So I will try to give you an overview and, like always, a little bit of a biased take that I have on this literature. But I really encourage you to read some of the fine survey articles that are out there, especially the one that I also relied on a little bit by Mike Bradshaw and Yonka Eric-Moore and a third co-author that I forgot, so apologies, in Foundations and Trends in Accounting in 2017. Really good piece, very, very extensive. And another thing that I will strongly encourage you to read is the study by Brown et al. That is published in JAR, that I also will steal some tables from, on the black box of financial analysts. Really great descriptive survey piece, extremely helpful to understand what analysts do. So what do they do? Here we start with a little bit of a characterization, but we will go in more detail. So the first thing that you need to understand when you think about financial analysts, that they come in two flavors. So there are sell-side analysts and buy-side analysts. And when in accounting we talk about financial analysts, without qualifying them, we're normally thinking about sell-side analysts. So sell-side analysts work for brokerage houses / investment banks normally. And so also think about also banks in general. And they provide equity analysis, investment analysis, to the clients of these brokerage houses or investment banks. So these clients normally will be hedge funds, mutual funds, pension funds, high net worth individuals, like they like to call them, and retailers. And so these clients then, they will make investment decisions based on the analysis provided by the sell-side analysts, maybe. And the brokerage house will benefit from the fee, or the investment bank will benefit from the fee. And of course, the investment bank also has the investment banking business, which is very heavily related to mergers and acquisitions and IPOs and similar activities. And so this is the basic setup of the sell side. So that means that sell side analysts in general provide stuff that is publicly available to at least to the clients that they deal with. And what they provide is essentially, reports. In these reports, there are buy and sell recommendations, there are earnings forecasts, also maybe forecasts for other values. And then there are also organized conferences where, the clients can meet the management of firms. And, these are also relatively important, but you don't read that much about them. And then on the other side, on the buy side, there are, of course, also are analysts. So if you are a hedge fund or you are a mutual fund or a pension fund, you also have analysts. These are buy-side analysts. They also provide reports and expertise to the portfolio managers on the buy side that actually make the decisions on how to allocate the portfolios. And these type of information is normally not available publicly, so it's internal, it's within the buy-side institutions. And this is why there's very little research on buy-side analysts, because simply we cannot observe what they do. Yeah, makes sense. So now all this is basically the setup of these very specific but very important information intermediaries, and this is what we want to study. So for that, to visualize this, I like this graph, which is in a review article on Analysts. The review article itself, I think they are better. There are more current ones, let me put it that way. But this graph I still like. So because it tries to summarize all that I just told you, a little bit also about, what kind of information do analysts use, and what is important, and what do they forecast. And then, what it accumulates in this analyst report. Okay. So, how does an analyst report look like? Well, here I have a first page from an analyst report. This analyst report here runs for several pages, 6 or 7 pages. And you see it contains a wealth of information. So qualitative information, quantitative information, forecasts, assessments of the market condition, and background on the firm. They're always structured in a certain way, but this clearly also varies by brokerage house or by investment bank that you look at, right? And so these analyst reports they contain obviously much more information than just an earnings forecast. So when you look at the accounting literature on analysts, then you get the idea, then you get this idea that the earnings forecast is the most and all relevant thing that analysts actually provide. But you see that when you see this, you see that most analysts don't think about it that way. Yeah, so we will see this in a little bit more detail when we look into the very nice findings of the Brown et al. Paper. So I really think that if you want to do work on financial analysts, you have to read the Brown paper. It's really insightful. It's very nice. Yeah. So this also it gives you a good example on how to pull off a survey. I think it's really well done. Okay, so here we have so the Brown paper contains several of these tables, and I picked only 1 or 2 or 3 of them. But the others are also interesting. So again, read the paper. Here's a panel where they ask analysts how useful the following information pieces are for determining your earnings forecast. So they also have the same question for stock recommendations. Here I focus on the earnings forecast. And you see that analysts say the most important stuff is industry knowledge, my industry expertise. So understanding the business model. We also did our survey interview with investment professionals, and they always come back to this. So that it's, in order to be successful as an investment professional, you have to understand the business model of the firms that you're investing in. And to understand the business model of the firms that you're investing in, you have to understand the industry that the firm is operating in. So then you see that when you look at the other information items, you see that private communication with management is high up in the list, right? As is our earnings conference calls, management earnings guidance, and the quality and the reputation of the management. There you see a little bit of a gap, but you see that it's basically industry expertise plus management connections. Yeah, so these are the most important things for analysts. And then you also see, and for me, this makes me happy as a financial accountant, that the 10K also seems to be relevant. But you see, compared to the direct contact to the management, it's already a little bit less relevant. And then you obviously see that, other analyst forecasts and so on is no longer that many. So you also see that primary research, so actually doing research, generating genuinely new information, is not that important. So this also speaks to the question whether analysts actually produce new information or whether they reduce the disclosure processing costs. And it seems to be the latter. So they reduce the disclosure processing cost by pulling all this information together. And this is, of course, very important for this last component of the disclosure processing cost, that is the integration cost. So they provide basically the integration of these different pieces of information that are available, but they don't really necessarily generate new information per se. So this is a little bit of a dangerous argument, because you see that this direct communication with management is out there. So there is the possibility that they get something new and fresh out of the management, but you also know that regulation, fair disclosure, basically reduces the likelihood that management can just tell secrets to the analysts. This is not going to happen, right? So meaning that you have to understand analysts predominantly as a disclosure, aggregation, and sense-making machine. Okay, so the fact that they are not really a machine, you can see when you think about the conflict of interests that sell-side analysts have. So as you will see in a second, sell-side analysts have some interesting properties when it comes to their forecasts and their recommendations, and this has always been linked in the literature to conflicts of interest that they have. Yeah, so and to a large extent you can think about the analyst literature as trying to understand these conflict of interests, and this is why I really like that Brown et al. Took the time to actually ask analysts what they believe is important for their career and for their compensation. So you again see that they think industry knowledge is important. If they are smart industry experts and they really understand the industry well, then they think that they will be more successful, right? Then the next thing is, and this is interesting from an economic perspective as well, that they are really big fans of rankings, and there are different types of rankings. So there in the literature there was a lot of weight on the institutional investor ranking, but here Brown et al. Actually show that it's not that much the institutional investor ranking that seems to matter, so but more the broker vote. So there seems to be there is a voting regime where basically clients can vote over the quality of analysts, and these seem to be really important for how analysts are being viewed by their profession. So, and what makes this interesting from an economic perspective is that this basically starts a tournament game. Yeah, so I'm not sure whether you're familiar with the term tournament game. If not, Google it. But a tournament is basically a competition where the prizes are unequally distributed across the ranks, meaning the winner gets it all or the winner gets most of it, and and this has very interesting effects on risk taking. Yeah, so if you are towards the top, then you get risk averse. If you are a little bit below the top, then you get more risk loving because you want to reach the top, because this is where the prices there, where the prices are high, right? So okay, then you also see other aspects that are important: accessibility, responsiveness, professional integrity, and so on. And then you see the reports. So the reports is the first actual outcome that you see, the observable outcome. You see that they think their reports are what is being evaluated. And you also see that the accuracy and timeliness of your earnings forecast is actually down there, right? So they really think that, hey, this doesn't matter that much. So again, interesting, because yes, we think that in accounting that we really do see quite a bit of research on these forecasts, but analysts seem to think that these forecasts are not that important after all. Yeah, so I think this is important to know. Okay, so now next thing is what is it with these biases? So I already told you that analysts' forecasts tend to be a little bit biased, and now we want to be a little bit more precise. What kind of biases we are talking about. And here I think is the one picture that you should know when you think about analyst biases. This is a paper by Richardson et al. Published in Carr. You see that the periods that are depicted here are relatively old, but this is still going on. So it hasn't changed dramatically since then. And what you see here is basically the scaled forecast error. This is the forecast error, forecasted versus real earnings scaled by stock price. Yeah, so that you can think this like a percentage point, difference. So here minus 0.01 would be a 1% difference. So meaningful differences. So what you see here is that analyst forecasts start to be way too optimistic. Yeah, so they really they expect earnings to be relatively high. So they start with a negative forecast error. Yeah, and then they walk down this forecast error until they are pessimistic close to the quarter end. So that means they are pessimistic in a way that when the management reports the true earnings, this results in a positive forecast error because the management is reporting earnings that are higher than the forecasted earnings. So the management is able to beat the forecast. And this is the whole debate around this, that this is something that actually pleases the management because the management wants to beat the forecast. Yeah, so the management wants to portray itself in a good light and by saying, okay, we did better than the analysts actually expected, so we did better than expected. Great. So this is the idea of let's say the management pleasing behavior of analysts. Yeah, so and now you can think about, well, okay, I get that they need to be a little bit pessimistic so that the management can beat the forecast, but why do they start out so optimistic? Yeah, so why do they start optimistic and end pessimistic? And of course, this is not easy to settle for once, but the general idea behind this, or the general belief, I think, of the body of evidence is that they start optimistic also to please a little bit the management, because think about the annual conference call, and then you see that the analysts actually say, okay, I believe next year's earnings will be really good. Yeah, so they will be higher than this year's earnings. They will be large, right? So this signals to the market that the analysts believe a little bit the management, right? So the analysts support the management and say things will be better next year, right? And then they say, oh, maybe not that much better, until they actually converge to something where the management can actually beat the forecast, right? So this is this random walk. It's not random walk, of course, walk down of optimistic forecasts that Richardson et al. Identified, and that still is around, and also around in many countries. And yeah, it's a relatively persistent bias that most people believe the market understands and simply looks through. Okay, so now the second thing that is often seen as a bias is that analyst recommendations are much more optimistic, so they're not equally distributed. So what you see here is by year. This is, by the way, in the Bradshaw et al. A review paper that I talked about. Good read, good read. So in this plot here, you see bar graphs by year, so stacked bar graphs of the analyst recommendations. So, and you see towards the top, these are the strong buy recommendations, and then you have the buy recommendations, and then hold, and then sell and strong sell. So you see two things. The first thing that you see here is that there are many more strong buy and buy recommendations than there are sell and strong sell recommendations, and throughout the years. Okay, and the next thing that you see is that there is a little bit of a structural break around the early 2000s, and this is a structural break that was actually caused by regulation, because the SEC was imposing a rule that tried to separate, let's say, the investment banking incentives from the analyst incentives a little bit, by forcing analysts to publicly disclose how their recommendations break out across clients that their investment arm of their business has, right? And this, you see that this has had an effect, yeah. At least this is also the common understanding of the literature, that this is a regulatory effect. But you also see that it doesn't really change the thing to be equally distributed. So there still is this bias. Okay. So now there is another bias that I don't talk about here, so or at least not on a graph, and that's target price buyers. So there are also target prices, and these target prices are also way high. Okay, so that's the third bias, if you want. Okay, now why is this? There, of course, are always many explanations. And here you see that one survey question of Brown et al. That actually speaks to this. This survey question asked the question, well, what are the consequences if you are pessimistic and your forecast is way below consensus? So if you offset the optimistic bias in the beginning, and you're a little bit out of the, let's say, equilibrium behavior of the analyst peers. And you see, the first thing that you see is, well, they aren't really that sure about it. There's nothing where you say, okay, this is very likely to happen. Yeah. But the first thing that they say that is likely to happen is that they actually gain a reputation. Good. So it seems, but that this is that they think that this might happen, but they also see that there are costs attached to this. Although they don't think it to be very likely, at least this is what they find to be relatively most likely. And this is the loss of access to management. And the other thing, again, is also, basically no more love from management, because you're dropped out of the Q&A, future conference calls. Yeah, and also then, the damage of your employee's business. So this speaks to this investment banking versus analyst thing, right? They don't find this to be too likely. Yeah, and you see the other things basically don't matter. So this is interesting, and it seems to speak that there is not that much of an a conflict of interest problem. But Brown et al. Also conducted a small set of interviews, 18 interviews, and I think also the quotes that they have from the interviews are actually also revealing, and this is why I took the liberty to simply copy some of them here. I don't want to read them out to you entirely, but you see the first comment is actually about balancing two things. The one thing to be fair and honest in making forecasts and recommendations, but the other thing is to keep management happy. Yeah, so, and one reason which I really learned from the Brown et al. Paper, why you want to keep management happy, is that management access is something that sell-side research firms actually sell to buy-side people. So these roadshows, meetings, and so on, this is something that is important for the client of the sell side firms, right? So management contact is not just important for getting access to good information, being able to provide good analysis, but also because management contact is something that clients actually demand themselves. So I think this is interesting. Yeah. So the second quote just makes the similar point much more bluntly. Yeah. So I like this one because it's so pronounced. Most of the sell side is worried more about what management thinks of them than they are about whether they're doing a good job for investors. So this basically is very well fitting to this walk down anomaly that you saw, right? So the analysts want to be nice to the management, and the management, of course, of the firms, they also have an interest in pleasing the analysts. So they have a cozy setting where they're good friends, and then nobody really cares about the investors anymore. A little bit cynical, maybe a little bit over the top, but interesting to hear. So when it comes to the recommendations, I think there is a very good and to me relatively convincing argument why buyer recommendations are more common, and this is related to the fact that most of the clients are actually long only, meaning that they can only invest in firms and then in stock and then sell the stock at some point, but they don't go short. Yeah, so only hedge funds normally go short, mutual funds rarely so, and mostly only for liquidity reasons, and so pension funds and so on. I don't think that they even allowed to go short. So that means that if you have clients that can only go long, then clients are not that much interested in sell recommendations because they can only sell stock that they own, and obviously they don't own everything. So meaning that buy recommendations are simply more interesting to the clients of sell-side analysts. Okay, and I think that makes sense. So now the final point here is again about the link between investment banker business and analyst business within the sell-side firms, and so you see that this seems to be still there, right? So investment banking has large margins and brings in the profits for these brokerage houses and investment banks. And of course, if this is where the money is, then you don't want your analysts to behave in a way that is bad for the main business. Yeah. So and now if you think about a firm that you want to do M&A business with, and then the analysts keep downrating that firm or talk badly about it, then you can understand that this might not please the investment banking arm of your business. And even with all these rules, so by the way, Spitzer, I think, was the New York State governor that was part of the rulemaking here. So even after all these regulations, you still have this tendency to be nice to the investment banking arm of your business. Yeah? So I think that here again, what I like from of the Brown study here, that it brings together the survey evidence with the interview evidence, and taken together, of course, this all doesn't mean that this thing is settled, but it really gives you a lot of context, a lot of institutional insights to reflect upon. And so that to understand the financial analyst world better. By the way, there's also a nice chapter in Bradshaw et al. That talks about the life of an analyst and the daily routines of an analyst. So if you are interested in doing analyst work, I recommend you to really read these both pieces, and then also try to get access to some real life analysts and talk to them to get a feeling about what they actually do. Okay, so now, taking all this together, I think we have now a little bit of an understanding why sell-side reports, recommendations, and analysts tend to be a little bit biased. And now we can have another look at this by using a thing which is relatively new to the game, and that's crowdsourced forecasting. So, by the way, you can debate whether this is really crowdsourced. So it has been coined as crowdsourced in the literature. But I don't think that I'm entirely convinced that these are actually crowds, because the number of analysts that estimate on these platforms, so here we are using, for example, Estimize, that these numbers are not much higher than the normal analysts that are in, that are covering firms. So it's not really a crowd. It's not necessarily more of a crowd than the professional sell-side analysts are a crowd. So I'm not entirely sure whether this is a smart idea to call this crowdsourced forecasting, but anyhow, so it is the term that is being used in the literature. So there is a new working paper by Sandra Schaffhäutle and David Wieman. So David Wieman, our guest from the last unit, that looks into the bias of estimates on Estimize, a public estimation platform, and compares this to the bias that you see from normal IBIS analysts. So here, when you look at the left panel first, so what you see here is the comparison between our crowdsourced consensus and sell-side consensus, and what is the percentage of these consensus estimates that are actually optimistic, right? So when you look at the 50% line here, then this would mean that it is an equal number of recommendations that are optimistic and that are pessimistic. And then you see the typical walk down. Yeah, so here you have half a year prior to the announcement date, and you see that the walk down for the sell-side analyst is happening exactly like in the original Richardson paper. And you also see that it's really bunched around the prior quarter end, so minus 90 days, so 1 quarter ahead, and it really goes down, and the consensus becomes pessimistic. And this is very much less so the case for the Estimize forecast, and a potential explanation is that it is less pronounced because the incentives are different. So you don't have to please the management that much, right? So you don't have to walk that down, right? Now, when you see that also that also a little bit of a walk down is observable for the Estimize estimates, but if you exclude Estimize estimates that are that are being provided by sell-side analysts, because also sell-side analysts provide their input to Estimize, then you see that this kink in the quarter prior to the reporting date is actually gone, more or less. Yeah. So you see here, this is one neat way to use the data on from these crowdsourced forecasting platforms. You can contrast the forecasting behavior from commercial sell-side analysts with these forecasts, and you see that this bias here is really relatively unique to sell-side analysts. Right? It seems to be driven by the fact that sell-side analysts are sell-side analysts, right? And that's, I think, is interesting. Yeah. Okay. So another interesting area for future work, I guess. Okay, so now in the end, maybe the last question that you might want to ask is, well, I get it, but do these sell-side analysts actually add value by reducing disclosure processing costs, or by generating genuinely new information to the market? So something that was not known to the market before. So there is relatively convincing evidence out there, I'd say, based on instruments for analyst coverage, because analyst coverage, of course, is highly endogenous. It's driven by a ton of factors that we cannot observe, so we cannot simply correlate analyst coverage with outcome measures. So we need some proper exogenous variation, and there are two papers here that come to mind. One is Kelly and Lundquist. They look at brokerage closers. And then there is the paper in QJE by Hong and Kasperczyk that look at mergers of brokerage houses, right? So both are reasonable instruments, and what the studies show that use these instruments is, first of all, that coverage loss reduces liquidity of a stock, and it tends to increase the information asymmetry and also the cost of equity capital. That's the original Kelly and Lundquist paper. Which, by the way, relate this test very much to the Easley O'Hara world in market microstructure, what we talked about in the last unit. Okay, so now there are also other papers that show that there is a reduction in total assets, meaning that there is maybe less investment, less growth for the firms that lose coverage. That sounds bad, right? And also that maybe governance is becoming weaker. So the Chen et al. Paper that shows that there is increase in managerial rent taking. But there's also another aspect. This is a typical accounting paper by Irani and Oesch in JFQA that shows that, hey, maybe there's also an advantage from losing coverage, because now managers shift away from real earnings management, which is costly because it wastes real economic resources, to accrual earnings management, which maybe might annoy the accountants, but is not costly because it's just, different depreciation or whatever rules, right? So, this is interesting. So maybe this hints at a potential benefit from not having an analyst. Yeah. So of course the question is whether this outweighs the costs of not having an analyst. Yeah. So based on what you see here, you most likely would have your doubts. But I think one thing that is also important to think about here, that all these evidence, of course, does not speak to the direct costs that are involved with actually producing these these analyst reports and all the information. And also, and this is something that I personally find interesting, it doesn't really speak to the question of the counterfactual, what would happen if we wouldn't have analysts? What would be the alternative information intermediary that would take the role of the analysts? Because obviously there is a demand for an information intermediary that helps market participants to reduce their disclosure processing costs, and in particular, the acquisition and the integration cost, right? So, and maybe also the awareness, so maybe all components, and there is demand for this service, and the question is only whether this service is currently organized in a very efficient way, right? So it also is relatively obvious that the whole business model of sell-side analysts has come under some stress over the last decades, and most likely because the actual output is so easy to reproduce and distribute, and it's a little bit like the music industry, right? So it's easy to make a copy of an analyst report. And this is, of course, a threat to the value creation that analysts provides. And it's interesting to see how this all develops, and whether there will be alternative ways of fulfilling this information intermediary role. That the role in itself is important, I think there's very little doubt. Okay. So this is it, what I wanted to tell you about financial analysts. Interesting topic. Maybe I should start working on this topic, but I don't know. It's so many people that are way smarter than I am are already working on this. So my guess is it should help you to get started. And again, like in every slide here in this unit, I have all the literature here in the last slide. I'm not showing you this normally, but here just to make this point again. I think if you are interested in diving into this literature, the first two references here are excellent starting points to familiarize yourself a little bit with the setup. Okay. Cheers, everybody. Next up, our final video of this unit is on the media. Okay, so see you in a bit.